Just like the Greek and Roman myths we learned in school, the stock market has a lot of its own myths when it comes to analyzing and evaluating winning stocks. One of those myths is that a stock needs to have a low price to earnings ratio in order for investors to attain substantial gains on their investment. The PE ratio is a basic way to gauge a stock's valuation, or how its share price compares with the company's earnings. This is usually calculated by dividing a company's stock price by its trailing 12 months of earnings per share. The idea is that the lower the ratio, the more attractive the stock is. If a stock has a high PE ratio, the myth is that this automatically means the stock is overvalued. A lot of investors look for stocks with PE ratios equal to or lower than that of the S&P 500. To a lot of investors, the PE ratio is the single most indispensable factor to consider for any investment. But here's the thing, much like the Greek gods, the importance of the PE ratio as a leading indicator to predict a winning stock is a myth. Oftentimes, stocks with low PE ratios aren't actually the best stocks to buy. In fact, decades of IBD market research has found that winning stocks tend to have PE ratios that value investors considered too expensive, even at the start of their giant price runs. As long as a stock has superior fundamentals, institutional support, and other traits of market winners, the valuation doesn't matter quite as much. Take, for example, Qualcomm. In the late 1990s, the chipmaker had a PE ratio of 140 when it broke out of a cup with handle base in early 1999. After its breakout, Qualcomm stock advanced a whopping 2,700% by the end of that year. Just a few months before the peak of the dot-com era, Qualcomm was one of the big winners for IBD founder William O'Neill. He discovered the limitations of PE ratios after conducting in-depth research on what exactly caused stocks to explode in price. Strong earnings growth, especially in the two most recent quarters, was a key factor shared by these winners. But he found that the PE was usually well beyond acceptable levels when stocks began their big price advances. In his book, How to Make Money in Stocks, O'Neill explained that high PE ratios were a result of accelerating earnings growth, which is what attracts institutional investors to stocks and causes their share prices to soar. He said that while PE ratios can be a useful indicator when evaluating the cream of the crop stocks, they shouldn't be the main reason for not buying a particular stock that's strong on fundamental and technical indicators. So, the next time you see an analyst downgrade a stock because its PE ratio has gotten too lofty, just remember some of the market's biggest winners have launched incredible runs while their PE ratios were already pretty high.